Hello and welcome back to Principles of Accounting 1. I am your host, Dr. B. We are currently in week 2 of our Principles of Accounting 1 course. In the first week, we had our introduction to financial accounting. We explored the income statement, balance sheet, statement of owner's equity, a little bit of statement of cash flows. And we also discussed debits and credits, and the related transactions that impact debits and credits. We also talked about Sarbanes-Oxley Act, and we also discussed quite a few of the principles of accounting that govern accounting. Here in week 2, we're starting to move from our journal entries that we learned about in week 1. In week 2, we're going to build on what we learned about in week 1. In week 2, we're going to be building on that. We're going to be talking about adjusting entries. The idea of adjusting entries is we are making adjusting journal entries to account for transactions that have happened but have not yet been recorded. And we'll go through a couple of examples of that. And also in today's discussion, we'll be looking at, in addition to the adjusting entries, we'll be looking at a new statement called the adjusted trial balance. We'll look at unadjusted trial balance, adjusted trial balance, and we'll also look at closing entries, post-closing trial balance, and we'll also discuss a couple of ratios. So a lot of content we're going to cover today in a very short amount of time. So let's go ahead and jump into today's lecture, and then we'll also discuss what's going on for this week. Okay, let's click view, and oh, sorry. Look, I'm in the wrong view. I'm going to click slideshow. Okay, here we go. So as I had mentioned, the idea of adjusting entries is that we are making the journal entries for transactions that have already happened, that have not yet been entered. And to do that, to make those adjusting entries, we go through this process called the adjusting process. So at the end of every accounting period, which could be a month, quarter, half a year, we typically do this at the end of every month. Just give you an idea of how it works in practice. At the end of every month or every accounting period, we go through the adjusting process. So at the end of the accounting period, we prepare an unadjusted trial balance. And what this does is it verifies that our total debit balances equal our total credit balances. Now, last week, when we started this whole adventure, I had mentioned that your debits must always equal your credits. And that's very true. Otherwise, what happens is that the accounting equation gets thrown out of balance. And the accounting equation must always be in balance. Assets equals liabilities plus equity. That must always be true. Your debits must always equal your credits. That must always be true. And to verify if that is the case, we run what's called the unadjusted trial balance. And there are situations where your debits don't always equal your credits. And what causes things like that to happen? There's a couple of different transactions. One would be collecting unearned revenue. One would be making prepaid expenses, accruing wages, accruing taxes, or deferring things. So accruals or deferrals are the reasons for the debits to not equal credits. And we're going to talk a lot about that during the next few minutes. So some accounts on the unadjusted trial balance require adjustments because some expenses are not recorded daily. So, for example, if I am running a manufacturing business and I'm using supplies on a daily basis, it's not every day that I'm recording the consumption of those supplies. Okay. That would be a lot of small entries to make every single day. So instead of doing that, at the end of the month, we make one big entry to reflect the consumption of those supplies. So that's one example. Another reason why we make adjustments is to recognize revenue and expenses that were incurred in as time passes rather than separate transactions. Example, prepaid insurance. Prepaid insurance, example of prepaid insurance. At the beginning of the year, I pay my insurance for the entire year with one big check. Okay, very common. Sometimes you get a discount for doing that. Over the time, as time passes, I need to record the consumption of that expense. It goes from being a prepaid insurance to an insurance expense through an adjusting entry. So, for example, when I pay the insurance at the beginning of the year for the entire year, I record it as a debit to prepaid insurance and a credit to cash. Okay, that reflects the payment of prepaid insurance. At the end of the first month of that year, I need to recognize that I have consumed a month's worth of my insurance expense. So the way to do that and that adjusting entry is we would debit insurance expense and credit prepaid insurance. And what that adjusting entry shows us is the consumption of that prepaid insurance over time. The same can be said with unearned revenue. If unearned revenue, just to remind you, is when we collect revenue from our customers before we perform the service or deliver the goods. That's unearned revenue. It doesn't become earned until you perform the service or deliver the goods. So in this example on the slide, we have unearned rent. Let's say we have a rental building and we have tenants in our building and we collect rent over time. We have a tenant that pays us in advance. Okay. So we have a tenant that pays us on the 15th of each month for that next month. So let's say right now we're in May. So let's say on May 15th, I paid my rent for the month of June. The landlord records that payment as unearned rent. It doesn't become earned until the service is provided, meaning it doesn't become earned until June 1st. So the landlord records the rent as a debit to unearned rent. I'm sorry, a debit to cash and a credit to unearned rent. The reason why I credit to unearned rent is because unearned is a liability account. At the beginning of June, the landlord will then make at the end of June, the landlord will make an adjusting entry where they will debit unearned rent and credit rent revenue or rent income, whatever the income expense account is. And so that will be the adjusting entry. So to kind of sum up the whole concept is we make adjustments for transactions that have happened that have not yet been recorded, or we make adjustments to reflect the passage of time for revenues or expenses that we have paid in advance. And that once it's consumed, then we record the transaction, the adjusting entry. And this is called the adjusting process. When we make these adjusting entries at the end of each accounting period, and they reflect that, and they will affect at least one income statement account and at least one balance sheet account. So I gave the example of unearned rent. Unearned rent we affected the income statement account through the adjusting entry, where it became rent revenue, and we impacted cash on our balance sheet account and our unearned rent account on our balance sheet. So there's always going to be an effect on an income statement account and a balance sheet account. Now, just to recap, to remind you of what's on the income statement. Income statement, we have our revenues and our expenses. Your revenues are from your sales, and your expenses are your daily operational expenses, right? You know, from bill, like utility bills, rent expense, wages expense, so forth and so on. Your daily operating activities, expenses. That's on your income statement. On your balance sheet, you have assets, liabilities, and equities. And there's a lot of accounts involved with each one. We're going to talk a little bit about that here in a second. So through that adjusting process, we make the adjusting journal entries. There are two types of transactions that typically require adjusting the adjusting process, or the adjusting journal entries: accruals and deferrals. So accruals, which is what we talk a lot about in this course, accrual-based accounting. Accruals occur when revenue has been earned or an expense has been incurred, but not yet recorded. Not yet recorded. Example of accrual accounts, it would be accounts receivable and accounts payable. Okay, accounts receivable means we provided the good or the service to the customer, but the customer has not yet paid us. Okay, customer has not yet paid us, so it creates what we call an accounts receivable. So first transaction, I make the sale. Okay, here's how it works. I make the sale, first transaction. So in the sale of the product, I first, let's think here. I first will debit accounts receivable and credit sales. Debit accounts receivable, credit sales. Okay. Also within that first transaction, or I guess the second part of that first transaction, is I will recognize the cost of goods sold. So I will debit cost of goods sold and credit inventory, okay, to reduce my inventory recognized cost of goods sold. So that's part of the first transaction. The second transaction is when the customer actually pays me. Okay, so let's say 15 days passes, 30 days passes, the customer pays us for the sale that we made to them. I would debit cash and credit accounts receivable. Okay, that is an accrual entry. The second type of accrual entry is accounts payable. I believe in the last week we talked about accounts payable a little bit. The example I gave was a utility bill. So on the 15th of this month, I received my utility bill from last month, right? On the utility bill, it showed April 1st to April 30th. Okay, so the full month of April on the utility bill, I received the bill May 15th. That's very normal. That's very normal. Okay, so the consumption of the electricity actually happened in April. I didn't get the bill till May 15th. So the way it works is I make an adjusting entry. I date the bill April 30th. Why do I do that? Because the consumption of the electric actually happened in April. According to the matching principle, we recognize the expenses when they happen. Okay, so we date the bill end of April. The first part of the transaction, first transaction is I am going to debit my utility expense for the month of April to increase my expense. And I'm going to credit accounts payable to reflect that I owe the utility company money, but I have not yet paid them. Okay. Then in May, I'm going to pay that bill. So end of May, I pay the bill, I debit accounts payable and credit cash. And so that is that first transaction that I made for the accounts payable example, that's an adjusting entry. The reason why it's an adjusting entry is because April already happened. Okay, the passage of time has already happened. I have already consumed that electric, but I didn't get the bill until the middle of May. So I make an adjusting entry for the end of April to reflect the consumption of that electric by entering the bill in April. Make sense? All right. Okay, so looking at a couple of examples, accrued revenue, accrued expenses for accruals. Let's see here. For accrued revenue, meaning we first receive, let's see here. In this example, I earned revenue at the end of the accounting period. And there was no adjusting entry, there was no original entry made for the revenue that has been earned. So I debit accounts receivable and credit revenue, which means I increase my accounts receivable and I increase my sales account to represent the sales that I made, the revenue that I earned. For expenses, this example, I incurred expenses in the previous month, but have not yet recorded them, like my utility bill. So I would debit my utilities expense and credit accounts payable. So that's accruals. Now let's talk about deferrals. The word defer means to put off, right? Defer, I defer it. I'm putting it off. A deferral in accounting is when cash related to a future revenue has initially been recorded. Okay. So an example of this would be unearned revenue. A revenue is unearned, meaning I received the cash, but I have not yet provided the good or the service to the customer. Therefore, it is unearned revenue. Unearned revenue is a liability account. The reason why it's a liability account is because the customer has legal claim to those funds until the point that I provide the good or the service. So therefore, for the company, it's a liability. It becomes earned revenue when we perform the good or the service. And for this transaction, for unearned revenue, we debit cash and credit unearned revenue. Then when we earn the revenue, we debit unearned revenue and credit revenue. That's the adjusting entry. For prepaid expenses, like prepaid insurance, for example, This is cash that we paid for future expenses. We have not yet incurred them. The example that I gave us for prepaid insurance, we debit prepaid insurance and credit cash. Then at the end of that accounting period, when we actually incur the expense, we will debit insurance expense and credit prepaid expense. And that's what this looks like. That's exactly what we just talked about. I forgot this was on the next slide. All right. Okay, so part of the adjusting process is that we create this thing called an unadjusted trial balance. Now, as I had said, the purpose of an unadjusted trial balance is to verify that your debits equal your credits. And as we just found out, there are some instances when that may not always be the case. In the event of accruals or deferrals that impact these types of accounts. And this is an example of an unadjusted trial balance. At the top, it'll have company's name, the date, unadjusted trial balance, and then it'll list out all of your accounts. They'll start with assets, then it'll go into liabilities, then equity, and then you'll have your revenues and your expenses, just like it is in your chart of accounts, right? And that's, so it'll have all your accounts listed out, the account number, the debit and credit balances, and then at the very end, the two should balance. And if it doesn't, clearly we need to make an adjusting entry. So let's take a look at an example of one of those adjusting entries. So our company signed an agreement with another company on December 15th. Okay, we got to see where this is going, right? December 15th to provide services rated $20 per hour. At the end of December, we need to make an adjusting entry based off of the number of hours performed during the month of December. It does not spill over into January. January is its own accounting period. So another example of this is like wages. Let's say the end of the year or end of the month is in the middle of the week. It's on a Wednesday. Well, what happened to Thursday and Friday? It's part of the same billing period or during the same check period, but it doesn't get accounted for during the month of December. It actually goes to the following month. So we have to make an adjusting entry to reflect what has actually happened during that accounting period. So in this example, we account for let's see how many hours. We account for 25 hours of service provided in the month of looks like 25 hours in the month of December. So $500. We debit accounts receivable and we credit fees earned. That's the revenue earned, right? Earned revenue, sales, whatever you want to call it. So what happens? What's the impact on the accounting equation? We increased accounts receivable by 500 asset account, and we increased sales, which holds a credit balance, normal credit balance, and that is eventually becomes a part of stockholders' equity. Now you're wondering, how is it stockholders' equity? Because you had already told us that revenue and expenses are on the income statement. This is clearly a balance sheet. Well, I'm so glad you asked that question. The reason why we recognize revenue and expenses under stockholders' equity eventually is because at the end of each accounting period, We go through the accounting cycle, and at the end of the accounting cycle, we do our adjusting entries and we close our temporary accounts through the closing process. Temporary accounts are the accounts on the income statement, and those temporary accounts get closed out to stockholders' equity through the process of net income. Exactly. And so that's why we see it on the balance sheet over time. So let's take a look at the chart of accounts. We talked about this very briefly in our last session, but we're going to go into a little bit more detail today. So the balance sheet. The balance sheet, we have assets, liabilities, and equity. Under assets, we have things like cash, accounts receivable, supplies, which is also known as inventory. Prepaid insurance. Remember, prepaid accounts are considered assets because the company has legal claim to those funds until they're used, of course. Land, equipment, accumulated depreciation, which we're going to talk about depreciation here shortly. Under liabilities, we have things like accounts payable, wages payable, unearned rent. Remember, liabilities are things that we owe. Things that we owe. Assets are things we own. Liabilities, things that we owe. And then we have stockholders' equity. This will include things like common stock, retained earnings, and dividends. Under retained earnings, we know that retained earnings are generated from, we have our net income minus any dividends equals retained earnings. Retained earnings, those are funds that are retained into the business. They're left in the business for business activities. Go ahead, Joe.
Yeah, what is the difference between retained earnings and a cash account over on the other side of the equation?
Okay, great question. So cash is physical cash. That is the cash coming into and out of the business for operating activities. That is cash, right? It's the physical paper money that is exchanging hands between the business and the customers and the investors and whoever else. So that's cash coming into and out of the business for operating activities. That's what cash is. Retained earnings is from your revenue. So revenue minus expenses equals net income. Net income minus dividends equals retained earnings. Retained earnings is the revenue that is retained in the business. Does that help to answer your question, Joe?
Yes, it does.
Awesome, very cool. Thanks for asking. Cool. And then, of course, dividends are payments that the business makes to shareholders, stockholders, investors, so forth and so on. And not all businesses do that. And on our income statement accounts, we have revenues and expenses. Revenues are that's cash coming into the not technically cash. Those are sales made by the business. Like sales can of course, as you know, be either cash or be made on account. When it's on account, that means accounts receivable. So fees earned, rent revenue are examples of revenue. And then of course we have expenses: wages, supplies, rent, utilities, insurance, depreciation, miscellaneous. The list goes on and on. Those are just a few examples of those types. So how does adjusting entries affect something like accrued revenues? Excellent question. So in this example, we can see how accrued revenues can have an impact on our reports. In this example, we did not yet record revenue that was earned, okay? We have not yet made the adjusting entry. So if we did not yet make the adjusting entry, the report is misstated. In other words, I am under-reporting revenue by $500. I have not yet recorded the $500 sale. Or I have not yet recorded the revenue earned, right? So because of that, I understated my revenues by 500, which means I understated my cash by 500. I also understated my net income by 500, and which also means that I understated my stockholders' equity by 500. So we can see the importance of making adjusting entries. If we do not make the adjusting entries, there is a strong possibility that we will misstate or misrepresent our company, misrepresent our sales or our expenses or whatever the adjusting entries are related to. Here's another example. We have an employee that we pay every other week. Okay, we're approaching the end of the year. Oh my, so what do we do? What do we do? During the month of December, we paid $950 in wages on December 13th and $1,200 on December 27th. As of December 31st, we owe $250 in wages to the employee for that Monday and Tuesday, December 30th and 31, respectively. What this tells us is we're at the end of the month. So at the end of each month or each year or both, it's always both. At the end of each accounting period, we make adjusting entries for our accruals and deferrals. Now, December 30th and 31st land on Monday and Tuesday. Okay. So we need to make sure that all of our expenses and revenues and anything else that is incurred in the month of December is allocated to the month of December through adjusting entries. And so we need to record the $250 that we owe our employee that worked during the month of December through an adjusting entry. The entry is debit wages expense $250, credit wages payable $250, and dated December 31st. When we date it December 31st, it falls into the month of December. And what's the impact on the accounting equation? Increase in liabilities and an increase in stockholders' equity. Okay, so we're going to pay wages of $1,275 on January 10th. This payment includes the $250 that was accrued in the previous month. Because, we're not just going to cut a check for $250 on December 31st. That would be silly. We're going to pay the employee later, but we recognize that that expense in the previous month. So we debit wage expense $1,025, debit wages payable $250, and we credit cash $1,275 to represent us paying our employee for the 2 weeks worked that included the end of the previous month. And this is a nice graphical representation of that. So if you look at a calendar, you're like, oh, December 30, 31 falls Monday and Tuesday. And then the next accounting period, which is January, starts in the middle of the week. We pay our employees every other week. So based off of the hours worked from the previous 2 weeks. So that's why we make those types of accruals. And we can see what would happen if we were to not make that entry. What happens to our statements? We'd be understating our expenses by $250 if we were not record that transaction, or before I recorded that transaction. We would be overstating our net income by $250 and overstating our stockholders' equity by $250. Just kind of shows us the effects, right? That's the idea. Looking at unearned revenue. So unearned revenue, as I mentioned, is when we collect revenue before it is actually incurred or before it is actually recognized, right? Unearned revenue, customer paid us before we provided the service or sent out the goods. Okay, so end of the month, we have some unearned revenue. We have an unearned account of $360 that represents 3 months of rent from for December, January, and February. Well, since December is the end of the year, we record $120, which represents 1 month of rent for the month of December. So December 31st, I debit unearned rent and debit and credit rent revenue. That represents the revenue earned for the month of December. And that I will do the same entry for at the end of January and at the end of February. And of course, this shows us what would happen if we were to miss that entry, or what it looks like before that entry. My revenues would be understated by 120. Net income, it would be understated by 120. And on the balance sheet, we'd have an overstatement of liabilities by 120 and understatement of stockholders equity by 120. Here's another example. This one's prepaid expenses. I always like the interest expense because that's usually the most common. Unadjusted trial balance indicates a balance of supplies on account $2,000. Some of these supplies were used during the month of December. We still have some on hand. We assume that on December 31st, supplies on hand is $760. So we started the month with beginning balance 2,000, ending balance 760. So 2,000 minus 760 tells us that during the month we used 1,240. And we would make an adjusting entry to reflect the consumption of 1,240. So what do? We debit supplies expense 1,240 and we credit supplies. What this does is it increases our supplies expense and decreases our inventory by that amount. Okay, prepaid insurance, my favorite one. Okay, so what this represents is the month of December. So for the year, we pay $2,400 for prepaid insurance. We take $2,400 divided by 12 to get us a monthly expense amount of $200. We debit insurance expense $200 to increase insurance expense, and we credit prepaid insurance $200 to reduce prepaid insurance amount. And that's to represent the consumption of the insurance for the month of December. And we would do that for every month. At the end of every single month, we would make this journal entry. And this is, of course, what the impact on the on the financial statements, income statement, balance sheet of what it looks like before and after. Oh, here we go. Okay, this one's a fun discussion. Depreciation. The idea of depreciation is that over time, things depreciate in value. Okay, we know this to be true. There are, in business, we have fixed assets. Fixed assets include property, plant, and equipment. Okay. Out of those fixed assets, only 2 of them depreciate: plant and equipment. Land will never depreciate. The physical land never depreciates in value. Reason why is because land has infinite life expectancy, meaning the land will always be there. You can knock the building down, but the land's still there. You can clear the land's still there. You can do whatever, the land's still there in most cases. I mean, obviously there's a couple of extraordinary events that may occur the land not to be there, but for the most part, the land's still there. So we cannot depreciate land for that reason. It's infinite life. Buildings and equipment, plant and equipment, we can depreciate those things because they have a defined life expectancy. The government's really good at setting the life expectancy, although it's not always accurate, but they set the life expectancy. So when we depreciate something, we're reducing its value. How do we do that, you might ask? There's a couple of methods of calculating depreciation. But the idea of depreciation, it reflects the passage of time as we're utilizing our fixed assets to generate revenue. As time passes, our fixed assets lose their usefulness and their value. And so therefore we accumulate this thing called depreciation to reflect the reduction of their useful life. That's why that we say that things are depreciating in value. So how do we do that? So here's how it works. There's a couple of methods of computing depreciation. The most commonly used method of computing depreciation is called straight line depreciation. What that means is the asset loses the same amount of value every single year until it reaches the end of its useful life. I'm going to give you an example. Let's say our company has a dump truck, and we purchased that dump truck for $25,000. According to the IRS schedule of depreciation, or the schedule of useful life, that dump truck is expected to last, has a useful life of 5 years. Okay, we know it's going to last longer than that. IRS says it'll last for 5 years. Okay, so $25,000 lasts for 5 years. It has a salvage value of 0. Salvage value means how much is it worth at the end of its useful life. In this example, we're going to say 0. So to calculate straight line depreciation, we take the initial cost minus residual value divided by its useful life. So if my dump truck costs $25,000, I have a useful life of, I have a residual value of 0, and that's a useful life of 5 years. 25,000 minus 0 divided by 5, $5,000 per year of depreciation. That's an example of straight line depreciation. So at the end of each year, I make an adjusting entry for depreciation. The way it works is I debit depreciation expense, in my example, $5,000. And I credit accumulated depreciation, $5,000. Now, here's how it works. Depreciation expense will increase up until the full value of the asset is allocated to depreciation. And at that point, we remove the asset from our books. So up until the dump truck reaches 25,000 depreciation expense, then I would remove the asset from my books because it cannot depreciate further. Can't depreciate more than its value. Okay, so debit depreciation expense goes up over time. We credit accumulated depreciation. Accumulated depreciation goes up over time. Accumulated depreciation we find as an asset account. Why is it an asset account? Well, think of it this way. On your balance sheet, you have assets equals liabilities plus equity. Depreciation expense is an expense on the income statement. Okay. Accumulated depreciation is an asset account. The fixed asset is also an asset account. So as I'm reducing my asset account for my dump truck, my fixed asset, I'm reducing the value of that. It has to go back onto the as an asset under accumulated depreciation. The reason for that is because assets must always equal liabilities plus equity. And thus we call accumulated depreciation a contra account or contra flow account or a contra asset account. It's because as we're reducing the fixed asset value or increasing the accumulated depreciation to ensure that our total assets are always in balance with our liabilities plus equity. So in looking at that, land never depreciates. Buildings and equipment always depreciate. We have depreciation expense as the expense, and the contra account is accumulated depreciation. Here's an example of the transaction for a piece of office equipment. At the end of the respective month or the respective year, whichever one it is, we are, it's probably a year because $50, it's only valued at 1,800. We are recognizing depreciation expense, $50. We debit depreciation expense and credit accumulated depreciation. And again, we do that up until we recognize the entire value of the equipment until it reaches value of 0. The difference between the original cost of the equipment and the balance in accumulated depreciation is called book value of the asset. Sometimes called net book value, but usually called book value of the asset. When you hear the word book value, we also call this net realizable value of the asset. The realizable value of the asset is basically like saying this is how much it's worth right now, right? So because sometimes like if you go to buy a used car, for example, you're shopping for a used car. You're always wondering, how do they come up with these prices, right? Well, they use depreciation. Cars depreciate. It's an asset. It depreciates, okay? Anything with wheels and motors will depreciate by a factor of 2, just so in case you're curious. So what that means is that to find the value of that used car, you take its original cost minus its salvage value divided by its useful life. If the vehicle is X number of years old, you take your accumulated depreciation minus the cost of the equipment. Hey, and there you have it. That's the value of the vehicle. It's a simple computation that I strongly recommend that you compute next time you buy a used vehicle. Take the original cost of the asset minus its accumulated depreciation, and that'll give you the true book value of the car. It's a fun little tip for you. Okay. And of course, what happens before and after the recognition of the accumulated depreciation? Our expenses understated, income is overstated, assets overstated, stockholders' equity is overstated. So after we make the adjusting entry, all that gets fixed. Here's a couple of this is a summary of the adjusting process. Debit the asset, credit revenue. This is when we I'm sorry, for accrued revenue, we debit the asset, credit revenue, debit accounts receivable, credit sales when we're earning revenue, so forth and so on. For expenses, we debit the expense, credit the accounts payable. For wages, we debit wages expense, credit wages payable, and of course, eventually we pay it. This is kind of a summary of all those that we talked about. Of course, these slides will also be posted as always. So it's just like kind of a recap of all of the adjusting entries that we made throughout the past couple of slides. And we can see that these, and we made all these entries on the same day. Oftentimes what businesses do is, in practice anyway, we would make all of these adjusting entries at the end of the accounting period or at the end of each month. And these reflect those accounts that have been adjusted based off of their consumption, recognition of revenue. So again, just to kind of help you to understand this concept is adjusting entries are applied to accruals and deferrals. Accruals and deferrals, because we can see a lot of these are accruals and deferrals. Yes. Oh, sorry. Well, way too fast there. What happened? Okay. Sorry about that. And this is the ledger within the adjusting entries. I'm not going to dive too deep into this, but it just kind of shows you what the ending balances are. The adjusting entries shows the ending balances. Just nice visual representation to kind of understand what happens. You know, like if you're looking at a subsidiary ledger account and you see the adjusting at the end of each month, there's usually going to be an adjusting entry for accruals and deferrals. That's what the highlighted components are. Okay. So earlier I'd also mentioned that during the adjustment process, we have this thing called we already talked about the unadjusted trial balance. Now let's talk about the adjusted trial balance. And this is done after we have made the adjusting entries. We prepare the adjusted trial balance. And what this does is it verifies after the adjusting entries are made that debits equal credits. Okay, and here's a nice example of the adjusted trial balance. See that our list of accounts, we have, and the difference between the unadjusted and the adjusted is that in the adjusted, we see things like accumulated depreciation, depreciation expense, adjustments made to the payables, things like that. Now, when we, as managers, were looking at this information, we oftentimes want to perform what we call a vertical analysis. What a vertical analysis is we look at the balance sheet and the income statement as a percentage. Okay, so for example, what percentage of my assets or what is the percentage of assets that make up the entire business? So what we do is we perform what's called a vertical analysis. On the balance sheet, we express everything as a percentage of total assets. So total assets would be 100%. Cash might be like would be a percentage of those total assets. Accounts receivable will be a percentage of those total assets, so forth and so on. The idea behind it is we can identify what percentage of my balance sheet is equivalent to my total assets. The reason why we perform something like a vertical analysis is for managers to understand what is the percentage of each line item that is equivalent to total assets. And on the income statement, we express everything as a percentage of total revenue. And this is an example of what that looks like. Just kind of lets you know the percentages of each line item. The reason why this is helpful for management is we can look at and compare year to year the changes. Helps us to identify trends in our business. and it helps us to be more effective at managing expenses and liabilities and things like that. It's very, very useful. And this kind of shows you how everything's connected. One thing I had mentioned, I believe, in the last session is all of your financial statements are interconnected. And how are they interconnected? They're connected through net income. So in the very beginning of a business or anything, we have this thing called your income statement. Your income statement includes revenues and expenses. Revenues minus expenses equals net income. Net income gets transferred at the end of the accounting period, gets transferred to your statement of stockholders' equity. And statement of stockholders' equity represents your retained earnings. Well, how does that work? Well, we have net income minus dividends equals retained earnings. Net income minus dividends equals retained earnings. Retained earnings goes onto your balance sheet. So net income is related to the statement of stockholders' equity through your income statement is related to your stockholders' equity statement through net income. Retained earnings from your statement of stockholders' equity is tied to your balance sheet under stockholders' equity. And that is how the three financial statements are interrelated. So that's why we see that anytime there is a change to one of the financial statements, there is going to be a subsequent change to the others. This kind of shows you how all that looks. It's pretty cool. Now you can use a spreadsheet for performing your unadjusted trial balance, and what that does is it helps us to identify any type of errors. That's truly in practice, do we use spreadsheets? Yeah, we use them all the time. But even now, more than before, we rely heavily on accounting software to help us to identify any type of anomalies. In small, medium-sized businesses, they typically use something like QuickBooks or Mint or FreshBooks or whatever. There's a lot of accounting softwares out there. Medium to large size businesses will use enterprise software like Oracle, NetSuite, 3M, or M3. There's tons of different softwares out there to help us. Which I wish we could start using in this course, but it's for another discussion. So, just like I showed you before, there's in this slide, the flow of information shows us how interrelated everything is. Okay, so and looking at the financial statements, the income statement, revenues minus expenses equals net income. The income statement ultimately is prepared from the adjusted trial balance at the end of the accounting cycle, and this starts what we call the closing process. In the closing process, we transfer our temporary accounts from the income statement to the statement of retained earnings. That's what I showed you before. And so at the end of every accounting period, so at the end of every month, our income statement starts at zero. Okay. So for example, right now we're in the month of May. At the end of May, I'm going to perform my adjusting entries, perform my my trial balance, and I am going to begin the closing process by transferring my net income onto my statement of stockholders' equity through the closing process, which I'm going to show you here in a second. And in that process, when the closing process is completed, your income statement returns to zero. So therefore, I can start at the beginning of June with zero on my income statement. And at the end of June, I do whole thing over again. Okay. This is just kind of a recap of what happens on the statement of stockholders' equity. So the thing to know about statement of stockholders' equity, net income minus dividends equals your retained earnings. Net income minus dividends equals retained earnings. And oftentimes there will be a beginning balance. So beginning balance retained earnings plus or minus net income, minus if it's a loss, plus beginning balance retained earnings plus net income minus dividends equals your ending balance retained earnings. If it's a loss, it'll be a minus. And hopefully there's never a loss. Looking at the balance sheet, we know that the statement of stockholders' equity appears on your balance sheet for retained earnings and common stock, because the statement of retained earnings also reflects changes in common stock, whether you're selling or buying shares of common stock for the business. You'll see retained earnings appears on the balance sheet. That's, of course, how the two are connected. So the whole concept behind me showing you this is we use net income to close out for our closing entries, to close out our temporary accounts to our permanent accounts. On the balance sheet, everything on the balance sheet, we call those permanent accounts. Temporary means at the end of the accounting cycle, they get zeroed out. Permanent means they always maintain a balance. That's why we call it the balance sheet. They always have a balance on those respective accounts. And as you know, the balance sheet has assets and liabilities and equity. Within assets, we have two primary categories. One's called current assets, and then we also have long-term assets, or also known as fixed assets. So current assets include things like cash, inventory, accounts receivable. Cash, inventory, accounts receivable, or anything less than 12 months. That's called current assets. Current means 12 months or less. I can use them in 12 months or less. Current, 12 months or less. Long term is greater than 12 months. Long term, greater than 12 months. This would include property, plant, and equipment. Those are known as fixed assets. They're long-term fixed assets. Liabilities also divided into two sections: current liabilities and long-term liabilities. Current liabilities means these are liabilities that need to be paid within 12 months. Long-term liabilities are liabilities that need to be paid in greater than 12 months. An example, current liabilities would include things like accounts payable, the current portion of long-term debt, any short-term notes. Those are all current liabilities. Long-term liabilities would include things like a mortgage, a car note, a notes payable. Those are all long-term, meaning we pay them over longer than 12 months. So current assets include cash, notes receivable, accounts receivable, supplies, also known as inventory, and other prepaid expenses. Current, well, use them within 12 months or less. Notes receivable is like if we issued a line of credit to a customer. That's an example of that. Property, plant, and equipment, also known as fixed assets, include land, machinery, buildings, equipment. Current liabilities include things like notes payable, accounts payable, wages payable, interest payable, taxes payable, unearned fees. These are all things within 12 months or less. Long-term liabilities, things are due greater than 1 year. Then, of course, we have stockholders' equity. These are the rights to the owners. It's at the end of the balance sheet. Assets equals liabilities plus equity. Okay, here we go. Permanent accounts. This is what I want to talk about. Permanent accounts are accounts that always maintain a balance. They'll always be there. They're always going to have a balance. Those are the accounts on the balance sheet. Permanent accounts, they're accounts on the balance sheet. We also call them real accounts. You say they'll always be there. They'll carry forward balances. Then we have temporary accounts. Temporary accounts are the accounts found on the income statement. They get zeroed out at the end of each accounting period. Okay, that's why they're temporary. They don't carry balances forward. They're temporary. So at the end of the accounting period, the end of every month, definitely at the end of every year, we perform this thing called closing entries. Okay. So the reason why we do this is to zero, to make sure there's a zero balance for the next accounting period. This is where we transfer our temporary accounts to permanent accounts through the process of net income, of course. Entries that transfer these balances are called closing entries. Transfer process called the closing process. We oftentimes refer this to closing the books, locking up the books, whatever, closing the books. It's a two-step process. Step one, our revenue and expense accounts are transferred to retained earnings. How is that? Through net income, of course. Step two, balance sheet of dividends account is transferred to retained earnings account. Here's how it works. We debit our revenue accounts for their balances. I could already hear you. Oh, Dr. B, that's reversing it. Yeah, it's reverse. It's like a reversing entry, basically. We debit our revenues and we credit all of our expenses. And what that does is it zeroes out so we debit our revenues and we debit our I'm sorry. We debit our revenues and we credit our net income. What that does is it transfers all the revenues to net income. And of course, we credit all the expenses, right? So we debit retained earnings account for the balance, and we credit the dividends account for its balance. And what that does is it closes out all the temporary accounts. That's how we're able to get back to zero at the end of, or at the beginning of each month. It's pretty straightforward for the most part. It's really just the two steps. This kind of shows you what that looks like. These are the ledger accounts that are impacted. And we see the closing entries that's made for those respective accounts. Now, after that's done, we perform what we call a post-closing trial balance. What this does is it verifies that we are back at zero for the next accounting period through the closing process. So it's easy. It's very straightforward. And what this does is it completes the accounting cycle. So the accounting cycle is basically everything we learned about over the past past week and this week is what we learned about. It's called the accounting cycle. The accounting cycle starts with analyzing transactions, then you enter them, then the transactions, then you go through the trial balance process, post-closing entries, and that completes the accounting cycle. It's about 10 steps, give or take. And that's what the accounting cycle is. And it restarts every single accounting period. And that's basically the accounting cycle. That's what we learned about earlier. Just kind of illustrates everything we went through over the past 2 weeks. Okay, let's see. Let's look at an example. We'll talk about the entire cycle very quickly, just kind of recap, and then we're just about done. Okay, so chart of accounts. The chart of accounts, as you know, is the list of accounts used for each business. The chart of accounts is pretty much the same for every business. The names might be slightly different, but they start with your assets, then your liabilities, and then your revenues and expenses. Asset accounts, cash, accounts receivable, supplies, prepaid rent expense, accumulated depreciation. Then we move into your liabilities, accounts payable, salaries payable, unearned fees. Then we move into your equity accounts, common stock, retained earnings, dividends. Then we move into your revenue, fees earned. Then we move into your expenses, salaries expense, rent expense, supplies expense, depreciation expense, insurance expense, miscellaneous expense. So the list goes on and on. These are our journal entries that we made for the month of April. As you can see, for each journal entry has a date, the respective accounts that have been affected for those transactions, and our debits always equal our credits. Yeah, you can see this first transaction. There's a lot of stuff happened here, right? It looks like we received some cash. We also made some sales on account. We received some inventory. We received some office equipment, and we issued common stock in exchange for some of that stuff, for all that stuff. We paid our rent for the next month, used cash for it, so forth and so on. It's pretty cool. It's cool. The transactions go on and on and on throughout the entire month. At the end of each month, we perform our adjusting entries. We made adjusting entries for miscellaneous expense. We made adjusting entries for receiving some cash, adjusting entries for recognizing sales made on account, and adjusting entry made for dividends. Then we performed our unadjusted trial balance to verify that our debits equal our credits. We use our spreadsheet to identify the adjustments that have been made to ensure that our debits still equal our credits. And then we perform our adjusting entries. And we have performed the adjusted trial balance to ensure that our debits equal our credits. We close out our we create our financial statements, income statement, statement of stockholders' equity, our balance sheet. Then we perform our closing entries. We debit our revenue accounts, credit all of our expense accounts. What that does is it gets everything down to zero, right? We debit all of that to retained earnings, dividends, let's see. And then we have our post-closing trial balance. We ensure debits equal our credits. And then we examine the ledger accounts to ensure that everything is in place. So that's the accounting cycle. Now let's run through a couple of ratios very quickly. Let's talk about ratios. Why do we compute ratios in accounting? You might be wondering. Well, the reason why we compute ratios is for a couple of reasons. We do it to understand the overall financial health of our business. There are a couple of key ratios that you need to understand. We call these working capital and current ratios. The idea behind these ratios is that we identify the company's ability to be liquid, meaning how quickly can it convert assets into cash, and the company's ability to be solvent. Solvency is the company's ability to pay its debts. We need to understand liquidity and solvency through a process called working capital in the current ratio. What this does is it measures the company's ability to be liquid and solvent. So the idea of working capital is the difference or the excess of current assets over its current liabilities. It's a very simple computation. We take current assets minus current liabilities. That gives us working capital. The idea behind working capital is that we can use working capital to pay current liabilities to be solvent. We can also use current working capital to make investments into the business. So here's an example. We have our company back in 2013. We had current assets of 7,745. We have current liabilities of 1,390. That gave us working capital of 6,355. It's a nice ratio. Another ratio we look at is called the current ratio. This measures the company's ability to pay its current debts. Current ratio is very effective to understand if the company has the ability to pay its current debts. The current ratio, very simple computation, is current assets divided by current liabilities. Current assets divided by current liabilities is the current ratio. Again, tells us the company's ability to pay its current liability, the company's ability to pay its current liabilities. So current assets, 2013, we had 7,745 current assets. Current liabilities was 1,390. That gives us a current ratio of 5.6. In this case, with current ratios, the higher the current ratio, the better. And that, my friends, is the conclusion of today's presentation. We're about 20 minutes over, but real quick, I just want to take a look at the week 2, let you know where we're at. For this week, you have your couple of readings. Please make sure you're going through the learning resources. They're very, very helpful when it comes to your homework assignments. This week's a lot more straightforward than it was last week. You'll continue your work on your 10K projects. We'll have a discussion on the financial statements. There's a couple questions in there for you to answer. And of course, if you would like, I strongly encourage you to interact with your classmates, make a couple of comments, questions, things like that. It just makes the discussions more fun. Other than that, they're kind of boring, right? So we like to spice things up. And then you'll have your second homework assignment and your weekly report out. My recommendation, as always, to be successful on the homework is to first read through the learning resources. Second, go through the week 2 self-assessment, and then attempt the homework assignment. Just to kind of show you what the homework assignment looks like. So if we look at the homework assignment, just as before, it's 25 questions. You get 2 attempts at it. Each question is worth about 4 points. The first several questions they're really definition questions. We're basically asking you what are adjusting entries, what is the accrual process, if what's deferred revenue, what are prepaid expenses. A lot of the stuff that we talk about in this class, and I think I mentioned this last week, accounting is kind of defined as the language of business. That's why there's so many different terms, right? And we talk a lot about that. Couple of journal entries, a few math questions, of course. Just be very careful as you're reading through the questions. It'll for sure be beneficial. Just be very, and again, a lot of it has to do with what we're talking about. The language in the questions relate to the terms, right? If you know what the terms are, the questions become a lot easier. So that's why those readings are really important. And of course, in addition to these sessions. Any questions? Joe, are we doing okay?
Doing great.
Awesome. Very cool. Very cool. Okay. So, yeah, just take your time as you're going through the homework assignments. They're not timed. You have 2 attempts. My recommendation, definitely take advantage of the 2 attempts, because on that second attempt gives you the opportunity to review the questions that you missed, right? So definitely do that. If you didn't do that for the first week, go ahead and do it for the first week. I'm not going to stop you. But yes, please make sure you take your time through it. And but as always, each week takes like 10 to 12 hours worth of study time. So make sure that you're allocating enough time each day to do the work. You don't want to overwhelm yourself on the last day of the week. So, okay. So Joe, if we're okay, we'll go ahead and end the session. If you have any questions, just feel free to let me know. As always, if you need help with anything, if you want to set up office hours, you have my phone number, my email address. We could set up office hours. And of course, we could talk through the discussions. If you ever need anything, I'm here for you all the time. So please feel free to reach out. Thank you so much for your time today. I really appreciate you taking the time to join me. The session will be posted after it's recorded to the discussion area, along with the PowerPoint presentation. So thank you so much for your time today. I appreciate you, and enjoy the rest of your week.
Thank you.
Thanks, Joe. Appreciate you.
Bye.
Take care. Bye-bye.